Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Welcome to the 27th episode of Carson's Facts versus Feelings. I'm Ryan Detrick, Chief Market Strategist, and with me, as always, Sonu Varghese. And Sonu, tell us your title one more time. It keeps changing.
Global Macro Strategist.
Global Macro Strategist, a man amongst many, many talents. Well, Sonu, there's so much to discuss this week. We're calling this one Yellen Past Each Other, which if you paid attention last week, Janet Yellen and the Fed seem to be on different pages. There's a lot we want to talk about, Sonu, but first things first, I heard there's an election in Chicago and you keep getting phone calls. So if you get a phone call during this, just take it and all man the fort. What's going on in Chicago right now?
It's not going to be one phone call I take. I'll have to take 4 or 5.
Okay.
So we have a mayoral election that's gone to a runoff. My local alderman election's also gone to a runoff. So I'm getting double the number of calls than most of the people in Chicago here. So you think with just 4 candidates, there's only so many posters and cards you get in the mail. But yeah, now they're calling too. So pardon me if I have to run and take a call to listen to the pitch.
Yeah. There was a time when you got phone calls, you thought you're important. Now we can't stand phone calls when they're doing it like that. But again, this is the 27th episode of Carson's Facts versus Feelings. Yelling past each other. So now we're going to take a look at, again, the Fed last week, what they had to say, Janet Yellen saying something that ran kind of counter to what was being told by the Fed, and then just kind of the latest with Silicon Valley Bank and the banking crisis. We're going to take a little bit of a look at gold. We're seeing gold starting to shine a little bit. Going to say why we see potentially some better times coming there, then a little bit of an economic roundup, and then we'll finish things off with a look at kind of market sentiment, which remains extremely dour. Not too surprising looking at kind of what's been going on, but maybe from a contrarian point of view, that can be a sign that we could have a spring rally continue. So, Sonu, let's just start off with things. On Wednesday last week, the Fed did hike rates for the 9th time, 25 basis points, fairly as expected. But a funny thing happened, right? During the Q&A, everything was nice and calm. And then the market started, Jerome Powell was talking, market started to sell off. And looking back, what we found out was Janet Yellen was off talking somewhere at the exact same time in charge of the Treasury. And she made it, whereas Powell made it sound like, you know what, if you're a depositor, things are going to be backstopped. Don't panic. He kind of said that in so many words. She said, you know what, I'm not even thinking about increasing FDIC insurance yet over at the Treasury. And then the market sold off. That's why we're titling this Yellen Past Each Other. You've had a week to think about it. What is going on with the different views on kind of what's going on with how we should backstop things and what this crisis means?
Even after a week, I still don't know what exactly they mean.
Now, time out real fast. You've got a Fred shirt on. That's the St. Louis Fed database. Yes. Anyone that wears a Fred jacket has to know everything in this world. That's really cool, by the way.
No, it was. I had to rush to get these things. It's about a year ago or something. But speaking of the Fed and former Fed chair and now current Treasury Secretary Janet Yellen. I mean, look, you never want to, these folks have tough jobs, right? And the last couple of weeks are just one of those periods when the job gets even tougher and there's a lot of firefighting that has to take place. But there are different, there's the Fed, there's the FDIC who insures deposits, and there's Treasury. You think all of them should be on the same page. You want everyone to be on the same page. Especially in times like this. And like you said, the 25 basis point interest rate increase, 0.25% to where are they now? 4.75 to 5%.
Yeah, the upper range is 5. Mm-hmm. Yeah,
it's 5%. So they've hit that. It was kind of expected. I mean, but this is a very important meeting. And as you said, the irony being you just said like things were calm, right? That's not what we associate with these things, right? Things are calm, but they were, right? The S&P actually rallied about 1% after the decision was released. And as Jerome Powell, the Fed chair, was giving his press conference. And then, boom, Janet Yellen in front of the Senate, her comments hit the tape, right? And what she said, she was asked about, is there going to be a broad increase in deposit insurance? And she just says, it was not something we have looked at. It is not something we considered. Hello, say what?
Which is shocking, by the way. It's all anyone's talking about.
I know, literally for the last 2 weeks. And Powell, at the same time, had literally just said depositors should assume their deposits are safe.
Mm-hmm.
Right? Talk about, yelling past each other, right?
And so I'll jump in. So we've got that. Now, the good news is since then, it seems like calmer heads have prevailed. We've bounced, obviously, since the very heavy sell-off on Wednesday. One thing I want to point out about Wednesday's sell-off, though, is it was a bloodbath on Wednesday afternoon.
Yeah.
The final 90 minutes, really, since those different comments.
The market fell 2.5% after Yellen's
Okay, yeah,
comments.
So big drop. But the good news, Sonu, is we did see high yield actually up that day, right? So that was one small little sign that, if everything was truly spiraling out of control, I think I'd expect to see high yield weaker. Now, Sonu, let me see. I had something I was going to ask you here. Let me just make sure. Fed cuts, actually. Okay, he said the word tight 23 times, he being Jerome Powell at his at the conference. 23 times he said the word tight versus 8 last time. What maybe they asked him a question and the answer was tight 23 different times. Maybe that's what happened. But why did he say that word tight so many more times than last time?
He's talking about the labor market being tight, right? So when he says the labor market is tight, what does that mean? That means supply is a lot less than demand for labor. And for his metric, and you and I have talked about this, we don't think job openings are the greatest metric because people put up, it's not very hard to put an opening out there. Who knows how long it'll take to get filled, and may just remain there, right? On Indeed or ZipRecruiter or wherever. Right. I mean, the BLS does a nice job in trying to measure these things and accounting for that, but still. But that, anyway, irrespective of what we think, Powell likes it. And that's what matters, right? He likes job openings. Job openings are about close to 10, 11 million or so. It's still very high, right? Especially the ratio between job openings to unemployed workers is close to around 2, which is much higher than it was before the pandemic. It was about 1.2 or something. It was off the top of my head. So, but at the same time, supply is not there. I mean, the unemployment rate is at 3.6%. It went up from 3.4%, but it went up for good reasons, right? It's because more people started looking for jobs. And so the BLS started counting them also as unemployed. They came from out of the labor force back into the labor force, right? So that's actually a sign of, a healthy, very healthy labor market. Powell would say too healthy a labor market. And that's why he's talking about it's a tight labor market.
Exactly. And I want to thank everyone who listened to last week's podcast with Professor Siegel. We've hit a record number of listens, record number of downloads. That's really cool. Remember what Professor Siegel said? He said a lot of good things. If you didn't listen to it, go listen to it. I actually listened to it again just yesterday, just some new tidbits. I gave the interview and I forgot what he said half the time. There was so much good stuff there. But he said, everything that just happened with Silicon Valley Bank is almost equivalent to 2 to 3 separate 25 basis point hikes. Again, as things are going to slow a little bit. Lending's going to be tougher. If you're a small regional bank, are you going to really give that loan to, someone who's a little bit more questionable when the regulators are out there? So Sonu, in a way, I don't want to always just be glass half full here, but in a way, what happened with Silicon Valley Bank is kind of doing some of the Fed's work, is it not?
Yeah, and Powell literally said that. He said, market's obviously expecting 0.25%, 25 basis points increase in the Fed funds rate. They did that. But I think the bigger question was, what are they going to do with their dot plots? What are the dot plots?
Yeah,
this is their estimate of where interest rates will be in the future, right? Over the next, at the end of 2023, 2024. So before the SVB crisis hit, until March 8th, remember what was happening? I mean, it's still kind of happening. All the data was looking positive. We had stronger employment data, stronger retail sales, consumer spending, and of course, stronger inflation as well. So Powell and all the other Fed officials were sort of guiding markets to thinking, okay, rates are probably, back in December, we said rates may end up at 5.1%. Right now, we think it's going to be higher than that. And I think markets are thinking it'll go up to about 5.6%. Then, of course, March 9th, the SVB crisis hit. Everything just turned upside down, almost upside down. We don't think it's completely upside down. Things are sort of back to normal. So I don't want to say things are, we're in a huge crisis or anything like that. I think we are past that. But expectations have come down, right? And what's interesting is after the SVB crisis hit, so before Fed meetings, they have something called the quiet period, right? This is a period when Powell and other Fed officials don't give any more speeches.
I'll just jump in. It's one of my favorite
Yeah.
periods because they're not talking. Every day, all we
They're
talk
not
about, there's some
talking.
random Fed person I never even heard of has some comment that's all we talk about. I love the quiet period.
Yeah, no, that's great. Except that we had a crisis, so it was anyone's guess as to where policy would go. But I think markets had some sense that, okay, they're not going to be as hawkish as we expected them to be, and that turned out to be the case. They came in, released their expectations, the dot plot, and they basically left the 5.1% terminal rate for 2023 more or less intact, right?
Mhm.
And that's because, like you said, the Fed is expecting credit to tighten because of the banking crisis, and that's, that will work as a substitute for rate hikes.
Yeah, what's interesting is, okay, the Fed is saying, maybe rates, 5.1 is a terminal, but you look at like the 2-year yield, like we talked about the last couple of weeks, dropped from 5% to 4%, 10-year yield lower also. So the bond market might not be, buying what the Fed is selling there, but nonetheless, we've wrapped up the Fed pretty well. Let's take just a minute or two here on Silicon Valley Bank and the banking fallout. I'll just put it like this, Sonu. We haven't had any more bank failures in a couple of weeks. I know that's like how that's pretty low bar, but hey, I'll take it. And then we saw Silicon Valley Bank was just bought out yesterday. And oh my goodness, who bought them out? Sony, First Citizens bought them out. I didn't realize this. They're a bank in Raleigh. So a little old bank on one side of the coast bought a bank on the other side of the coast. And again, it was a really sweetheart deal. The bank, that bank was up like 50% on the buyout.
Yeah.
So hey,
that's a good sign.
What do you think?
No, that's a great sign. Like when I think the weekend after, it's funny how all of these things happen in March. You think back to March, what was it? March 2008, right? When Bear Stearns fell.
March Madness.
That was also March, right?
Yeah.
and suddenly over the weekend, the Fed jawboned some other bank into buying the failing bank. And we thought that would literally happen. But I think what the Fed, FDIC, Treasury didn't want to happen was they didn't want the big banks to get even larger and buy this. The Silicon Valley Bank wasn't, they lost a lot of assets and deposits, all of that, but they weren't exactly small. They were the 14th or 16th largest bank, something like that?
16th largest bank with 17 brick and mortar stores or banks, locations.
Banks. Yeah. So they weren't exactly small, right? And I think the authorities didn't want the big banks to gobble yet another one of these. So they were waiting for a smaller bank. But of course, everyone was worried about small banks. Is there a crisis at small banks? So that's why I think the very positive sign that this bank, First Citizens, as you said, based in Raleigh, they basically doubled their size, right, to about 220 billion in assets or something like that, which is, I think, just about where SVB was before the crisis.
I believe they were the 20th largest bank at the start of the year.
Like that.
Everything's been changed.
What? They maybe they were in 25th or 30th or something. I think they were smaller, but they've got a history of gobbling up these, I don't mean that in a bad way, of buying out some of these troubled banks. I think last year they bought, it's called not Citigroup, it's called Citi or something like that.
It wouldn't be Citigroup.
It wouldn't be Citigroup. No, they bought, and they are the ones who bought out. Do you remember Indy Mac?
Yes,
from way back when, that the failed mortgage lender back from the 2008 crisis. So they're the ones who bought that out, and now SVB, Indy Mac, they're all part of the same umbrella under First Citizens. Talk about things coming a full circle.
Wow, that does. And like you said, full circle is March, and it is March Madness. And just to call you out, 2 weeks ago, you said Purdue would win the whole thing.
Can I hide under my desk?
16. So no, and remember, everybody, if you don't believe me, go back and listen to the tape. It's kind of fun what Sonu and I do. Sometimes we're dead wrong, sometimes we're right. I did say UConn would win the whole thing 2 weeks ago.
Wow.
I'm a Xavier fan, so that was my heart, but my brain said UConn. Now the time we're recording this, they're in the Final Four. We'll see. We're not making this all about sports, but every once in a while I get one right. But how about the Final Four? No 1 seed, 2 seed, or 3 seed. And this is one of the craziest marches we've ever seen from markets. Maybe it's all related. Sonu, one of the potential benefactors to all the crisis and all the things that are going on is gold. Gold is something that we do have a small sliver of gold in some of our models portfolios that we run for our Carson Group advisors. But you and I are seeing some things on gold that we like. I'll go first and you can go second. Yeah. What I personally like, for 12 years, gold went up. All right, from 99 to 2011. The last 12 years, gold has gone absolutely virtually nowhere. It's gone sideways. It was down, yes, but virtually nowhere for 12 years. I look at an asset class that went up for 12, sideways for 12, and now it's showing momentum, showing some signs it wants to break out. You'll break down some fundamental reasons here in a second. But I like that, you know what? That's an asset that hasn't moved for a while. It might be getting ready to move. Yeah, it's a big, heavy rock. Doesn't mean that thing can't move up, though. So that's one thing I like about gold. What are you seeing that you think could be, again, we're not saying the end of the world's coming. We're not saying we see hyperinflation. We're just saying there could be a pocket of time where gold could do okay here. What are you seeing?
No, it's funny. Like you and I probably look at gold differently, but we've gotten to the same place, right? Just we think it may not be a bad time for it, from just a price perspective. And those cycles, right? Those cycles are important. Like you take a 12-year cycle from 2000 to 2010, 11, 12, and then now, then going sideways after that. And who knows, we may be at the beginning really of yet another cycle that may last the next decade. So I mean, you just said you said it, right? Gold is a big, heavy rock, which means you have to store it, right? And if you have to store it, that means you have to spend money storing it. Now, that's a cost, and there's always opportunity cost with these things, and that's where I think of gold with respect to or relative to real interest rates, right? Nominal interest rates minus inflation or expected inflation. So if real interest rates are negative, which they were for a good part of the last few years, I mean, from before 2021, but even in 2019 and all that, real interest rates are negative. Now, if real interest rates are negative, there's no opportunity cost to paying to store gold, right? Because you're not going to get anything at the bank. In fact, it costs you money over time to put money in the bank, right? Because real interest rates are negative. But now real interest rates are positive, right? And over the last year, the irony is when the Fed raised rates, real interest rates went up. Gold actually fell when, we had the highest inflation in 40 years, which is the irony of it, right? Most people think of, oh yeah, gold is what I want to have when inflation's high. The first 8-9 months of last year was not when you wanted to have gold. But then some things changed after that, right? The dollar went down, right, from October onwards. And real interest rates sort of like stabilized because the Fed I think markets are expecting the Fed to be done. And gold just surged, right? And we've seen that even over the last 2 weeks, right? Gold, real interest rates came down because growth expectations, fell because they thought crisis and all of that. So the irony of it is that gold is sort of like a hedge for crisis, right? It's a crisis hedge. So I think we're not saying there will be a crisis or anything like that, but just from that perspective, as a way to sort of have a little bit of a hedge, diversifying away from, you don't want your diversifier to equities being all in, long duration bonds, right? 10 plus, 20 plus, 30-year treasuries. You want to diversify that as well. And we think gold is a good option there.
Yeah, I mean, you look at last year, right? Stocks are down 20% on the S&P. Long-term bonds down close to 20%. Shorter-term bonds still did poorly. Gold was virtually flat. And I think you look at the big rally we had in the dollar last year, even the first 8-9 months, gold was hanging in there relative in the face of a strong dollar. So maybe it was a signal that the gold can hang in there when the dollar is strong. Now the dollar is weakening our base case. Maybe gold can do better. So anyway, so gold is something that we're actively looking at here in some of the models we run for our advisors, and maybe I'm going to do something there. We see some potential sparkling as it becomes to gold. Sonu, we've got about 5 minutes or so let's see if we can do this. Last week we had some economic data of various PMI services. Manufacturing came in much better than expected on Friday. Also, durable goods came in, and although the headline number wasn't that great, I know if you look at what's the one I wanted to say? The one that was up 0.2%. What was that?
Core goods. So you have durable goods orders, which are businesses buying, things like cars and computers, electronics, machinery, stuff like that, right? But they also buy aircrafts, and aircraft orders are very volatile, right? So the headline number is usually, because of what aircraft orders do, they can be all over the place. So you look at core goods spending, and there's defense in there, but you take defense out because, the Pentagon does what the Pentagon does. For good. And so if you take every other business in America and see, okay, what are they spending? We like to look at CapEx. This is basically an estimate of CapEx at the macro level, right? And that was up, you said 0.2%, right? In
More
February.
than expected.
Yeah, it wasn't
Yeah.
expected. I think it was expected negative or flat. So that's a positive sign that businesses are still investing. I think that's a great sign.
Absolutely. And then we also saw some data from our friends at Bank of America. They look at debit cards and credit cards weekly. So the very first week after all the stuff happened with the banking crisis, they said, you know what? We didn't see a slowdown in spending on credit cards and debit cards. Yes, only 1 week in. But again, that's something that we talked a ton about. One of the big reasons why we feel like we're on a lonely island, not expecting a recession this year, is because the economy, because the consumer remains fairly strong. And that's just another potential data piece there. So we saw some better ISM numbers. We saw that. I think there was something else I wanted to point out.
Some purchasing PMI data
Yeah.
came out from the
Yep.
S&P Global releases PMI estimates for the month, and they do this a week before the end of the month. Usually we get these things at the beginning of the month, but obviously everyone wants to be first in this business, so they release what's called a flash estimate, right? And those are positive. Like I think the manufacturing PMI for the US went up from 47 to 49. So if it's below 50, that means majority of the respondents think, orders and things like that are going down. So 49 is still, it still says manufacturing sector is under contraction, but it's better than what it was over the last 5 months, right? And the services sector actually jumped to about 53. That's also the highest in, I think, 11 months or so. That's really positive.
Yeah, I've got written down here 53.8, an 11-month high, expected 50, and then the composite, so combining the two, also came in over 53, better than expected. Sonu, you look at about 20 different, global economies, economies around the globe, and what you've noted the last couple of months, we've seen a lot of the manufacturing data. Yeah, maybe they're all, not all, but a lot of them are still beneath 50. But again, they've bottomed and they are increasing.
They're all turning around.
Yeah, the final thing, the Atlanta Fed GDP now, first quarter estimate, as of Friday at least, was 3.2% in the first quarter. I get it. That's backward-looking data. I've said it before. A lot of people, well, it's backward-looking. Yes, but at the end of January, they expect to be up less than 1%. So we're looking at maybe 2.7% growth in the fourth quarter. Let's say maybe another 3% in the first quarter. The economy just keeps surprising to the upside is the best way to put it. Anything else?
By the way, we're not. I would just say we're not quite done with this quarter yet, right?
True, good or bad, we're not.
Yes, not done with the quarter. As much as we would like to be, but we'll be done. Probably as this episode comes back by the end of the week.
Absolutely.
But this is my thing, right? The economy is, you probably don't want to take the Atlanta Fed number at face value 3.2%, but let's just say somewhere between 2 and 3%. That's fantastic. Yep. That's very good, because everyone, as you said, came into the year saying we're going to grow only about 0.4, 0.5%, if not have an outright recession, right? Even the Fed just came out with their, as I said, the dot plot statement of economic projections, or summary of economic projections. They said the growth in 2023 is going to be only 0.4%. Wait a minute, for that to happen, if the first quarter grows about 2 to 3%, that means things have to come to a crashing standstill for the next 3 quarters. Just as the world economy is getting better and activity is increasing, as we just talked about with the PMIs, right? So I don't know. I don't buy that.
No, I don't either. But that's why we do this podcast weekly, and we will keep diving into all the data. We've got like just a minute or two left, Sonu. I remember a while back, maybe 2 months, I bought some toothpaste. And I put it out, and it was dark. It was like dark black. And I go, what in the world is this?
The coal one, right?
Goes, and Emily's like, you bought charcoal toothpaste. And I looked, and believe me, if you looked at the box, you'd never know in 1,000 years it's going to be dark black toothpaste. It looks like regular bright blue Happy Crest toothpaste on the outside. I just finished that toothpaste, and a lot of people got a kick out of that. So I'm not buying charcoal.
Are you buying another one?
It worked fine.
Oh, okay.
I mean, whatever. It was fine. I went back to just a normal colored toothpaste. But be careful to all the listeners out there. There is a charcoal colored toothpaste by Crest out there, and it works fine, I guess. But I officially finished it, and I'm back to regular kind of white-ish color toothpaste.
Are you going to leave a review somewhere on Amazon? Are you going to leave a review? Or
no, I'll be nice. I mean, my big review is like, if it's black toothpaste, like make it clear on the box
on the
that
cover.
I'm buying black toothpaste. But whatever. It's all right. That's the worst thing that happens I can live with it. Final thing I want to talk about very quickly, and I'll just kind of do this, Sonu, and wrap it up. Market sentiment remains extremely dour. Not surprising when we see everything going on. Bank of America does a global fund manager survey. We've talked about this before. Look at about 20 different asset classes. Cash is the most loved, while U.S. stocks is the most hated, and equities is the second most hated. So again, that's just something. And now, believe me, we notice emerging markets were the second most loved, so it's not quite so clear cut. But the truth is, a lot of people are skeptical of what's going on, rightfully so. But as we just talked about the last half hour or so, there really are a lot of positive things that are happening with all this negativity that's out there. Just think about this. The month of April is historically pretty strong. The month of April in a pre-election year is up 17 out of the past 18 times in a pre-election year. We're about to go in April. We think a surprise spring rally could happen. And Sonu, one final comment. I just crunched a bunch of numbers this morning. There's something called the December low indicator. What does that mean? Well, if stocks, be the S&P 500, break their December low during the first quarter, bad things can happen. We saw that last year. That was a warning sign. Stocks are down on average when this happens for the full year and up less than 50% of the time when they break the December low in the first quarter. This is going to be the 37th time that did not happen in all likelihood, unless we have a major sell-off the next couple of days, which let's hope we don't. But looking at those 36 times, Sonu, where you held above the December low, for the full year, you were higher 34 of those times, up about 18.5% on average. So just a lot of numbers and a lot of things I just said. What I'm trying to say here is this is another little subtle clue that, I get it. Headlines are scary, but with this much negative sentiment, with the market that's hanging in there could be an upside surprise. Well, Sonu, we do need to wrap it up. Any final comments for the listeners before we send them away on the 27th episode?
No, I think that was all good. Thanks for your support, and we'll be back here week after week doing the same thing. I mean, so it's been going well.
Yeah, we're really excited. As long as everything goes smoothly, Sam Rowe is going to join us. He formerly at Yahoo, an excellent writer, economist, just all in all great guy. So Sam will be on the podcast next week with Sonu and myself. We're looking forward to that. And absolutely, thank you to all listeners who keep listening. Again, last week was amazing. If you didn't get a chance to listen to Professor Siegel, check it out. But with all of that, we will continue to do this podcast every week if you guys keep listening. And with that, the 27th episode of Carson's Facts versus Feelings is in the book. See everybody soon. Bye-bye. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM, LLC, or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM, LLC.